Welcome back to another episode of the Full Subjects podcast. This is our first recording in 2026, so thank you for joining us for that episode. Cole, how was your Christmas break? You guys do anything fun?
It was
Time with
good. It was
family?
relaxing. Lots of eating for sure. Lots of time spent with family. So yeah, it was good. How about yourself?
Yeah, it was good. Fortunately, was able to do a little bit of work while trying not to. Had a listing that sold, which is I wouldn't say a little bit easier, but just different type of work. But subject removal on the 30th, so squeaking one in before the end of the year, which was nice. And then some well needed family time. I'm sure you're feeling this too. People, it's that time of year where people get the sniffles and sick and all that kind of stuff. So just
Yes.
trying to dodge all of that. But no, it was a really, really great Christmas break. And we hope you guys that are listening had a great Christmas as well. First episode that we'll be recording is our much anticipated first stats episode of the year. I know you always laugh, but we're nerds. We love these ones. Yeah, going to be breaking down not only just the December stats, we'll end up touching on obviously the year recapping as well, which is good, and that'll kind of forecast us into other stuff that we'll be talking about. But yeah, thanks for joining us again. As always, this podcast is for informational purposes only. It does not constitute any legal, tax, investment, financial, or any other advice. It's not intended to cause or induce breach of any existing agency agreement. Nailed that. First one of the year. Don't worry about it. And then, as always, guys, if you're listening but not subscribed, how dare you? Please make sure to subscribe and leave us a 5-star review. We do appreciate that. I am just buzzing out the gate here. All right, Cole's notes. Let's go.
Guys got the caffeine flowing through the veins right now.
Bang. Let's go.
Yeah. So as Austin said, we'll do December, and then we'll also do a bit of a 2025 recap. So for this market update, it's not going to be a full 2025 recap. We're just going to look at recent CPI, so Consumer Price Index, which really what this is talking about, guys, is inflation. It remained steady month over month. So in December, it was 2.2%. October, it was also 2.2%. So things remain the same. A couple things to note here. Grocery prices rose about 2%, which everybody here is going to feel because we all buy groceries. So, and this was actually the biggest increase. Austin's laughing. This is the biggest increase since January of 2023. So about 3 years. And this is the biggest increase we've seen in 3 years on grocery prices, just month over month. Big reason for this, we saw fresh fruit, coffee, and beef see the biggest increases. Coffee's been one for a while now. I don't know how closely people follow this, but coffee's actually gone up a lot in price, and I think chocolate is actually another one that's gone up a lot in price. And a part of that has to do with trade. That's a big one, and then another one is just I believe climate in terms of where the areas where these things are grown has been impacted, specifically in 2025. So we're seeing a spike in prices in that. Beef, apparently there's a shortage in North America right now relative to what we're used to. So that's one of the reasons we're seeing an increase in beef prices. But anyways, grocery prices are up. Not great. It's going to hurt, obviously, paying a little bit more at the grocery store. And unfortunately, prices don't usually tend to come down. We don't want to see them go up too quickly, but we also don't want them to get too out of control here. So overall, actually, for 2025, so a little bit, I lied here. I'm going to talk about 2025 as a whole. The average was about 2% inflation for 2025, and it was about 2.4% in 2024 as contrast. So that's good news, but here's the bad news. The bad news is a big reason for that lower inflation in 2025 compared to 2024 was because of the removal of the carbon tax. So the carbon tax made up for about 0.5 percentage point of that inflation. When we put those numbers together, really inflation from 2025 and 2024 were very similar, and they were both sitting at about 2.5%. Now that's much lower than it has been in the past when we were dealing with 5, 6, 7% in some cases, but we're not seeing a massive increase year over year in terms of inflation coming down. In terms of rates, because that's what we like to talk about, we're not likely going to see a rate cut in 2026, at least in the near future. And actually, some economists are predicting potential rate hikes at the end of 2026. Now, I'd like to tread lightly on this because predicting rate hikes in the second half of a year is very hard to do because this data all comes out typically in a monthly fashion, and it's really hard to know what's going to happen 6+ months from now. But some economists are saying that. I think it's worth noting. And if there's anything to take away from this, it's that we're not likely to see any rate drops in the near future unless we see some changes in the overall economy. And then last but not least here, uncertainty remains. Like, I think that's pretty clear. There's uncertainty when it comes to what's going to happen with the Canada, US, Mexico trade agreement. Austin and I have talked about that a few times. There's still uncertainty with trade in general, just even outside of that agreement. There's uncertainty in the economy when it comes to a number of things right now. And even like there's global uncertainty when it comes to the state of certain countries, and we're seeing wars. We're seeing a lot of negative things, I guess. And a lot of people, I think, are a little bit hesitant to make any big financial decisions right now. So why I'm saying this is I think we need to see some reduced uncertainty or some stability before we're going to see the market rebound substantially. We will likely see changes in the market, but for things to shift dramatically, uncertainty really has to likely come down to a level where people are now comfortable making these big decisions and not worried about what might happen the next month when it comes to the global economy as well as the local economy. So not great news, guys, but overall, that's not why we're here. We're here to give you the facts as best we can and try to give you our interpretation of those facts. So yeah, that's all I got today.
With rates, a couple questions I have that you can answer. So with rates, have we not seen rates basically hovering for the last 2-ish months, 2 to 3 months of like, hey, within a couple basis points, maybe up, maybe down, depending on the flavor of the day, but relatively they've been hovering fairly stable, correct? Have we seen any increases in, or changes in bonds, which is affecting fixed or anything like that? Or has it been mostly pretty steady?
It's been mostly steady. We saw a little bit of a bump at the end of 2025 where there was a change in bond yields, which did affect interest rates a little bit. It seems like things have kind of come back down or relatively stabilized. So to answer your question more bluntly, yes, things have been pretty steady for the last number of months now. And on the variable side, of course, we haven't seen any more rate drops recently, so that's also remained pretty steady. Yeah, I would say overall rates are pretty predictable at the moment. You're still kind of sitting around that 4% mark. If I had to kind of stick a number at it, you're going to be a little higher in some cases. There's potential to get a little bit lower, but that's kind of the number you should base any calculations on for the most part, is right around that 4% mark. And what are we expecting in terms of fixed rates? Hard to say right now. As I mentioned before, uncertainty is obviously going to play into this and how the market responds to certain things in the news. But ultimately, rates are pretty steady. This is probably a mark where we're going to stay. Like this is a number where I could see rates staying relatively the same for the long term, like right around that 4% mark. It seems like a pretty reasonable place for us to be, but we'll see. Like I said, I don't want to try to predict too much because it doesn't take much for things to change, and it can change pretty quickly depending on sentiment and depending on how people react to the information that they're given. So yeah. Any other questions on that?
Yeah, I think very well said. And then my next question would be: we've talked more than once about how typically you're seeing when there is an increase in rates, like the Bank of Canada announcement. Typically, it's a cycle, so we would see one or more than one. Typically, I guess.
Yeah.
Do you anticipate that, or do they anticipate that? And I know it's tough, as you just had 15 disclaimers saying, it's very early to call what's going to happen at the end of the year when we've just started this year. But are they predicting 1 or 2 rate increases near the end of the year? Is it a bigger number than that? You just talk a little bit. The floor is yours.
Yeah, let's talk a little bit about why they tend to do either a rate decrease or a rate hike, and then I'll answer your question. So typically they want to do a rate drop because they want inflation or something in the economy is not going how they would expect. So they're trying to make it easier to borrow. They're trying to lower rates to make it cheaper to borrow so that they can have more money in the economy. That's Probably not the best explanation, but that's a very simplified way to look at it. On the other side of things, if they're going to raise interest rates, they're going to do it because they want to slow down the flow of money or make it a little bit harder to get access to money at a lower rate. So why would they do that? Because likely inflation is coming down, is decreasing maybe too much, and they don't want it to get too low, and they don't want too much money to flow into the economy, because if that happens, then we see what happened already in the past, where inflation will start to run rampant eventually. So basically what I'm trying to say is they're trying to keep inflation at a certain level, and they're trying to manage the flow of money at a certain level, and those two things tend to be related to each other. So they're just trying to manage how much money is accessible at what rate, so that they're not having people borrow too much money and then become over leveraged, or cause a situation like we had in the past, where it was really easy to get access to money when interest rates were really low and people were borrowing too much, and then we saw inflation run rampant, and then we had massive issues. So it's just trying to pull the levers when it comes to how easy is it to get access to money. To answer your question more directly, it's probably going to be one of those things where they like raise rates if they do, just to try to slow things down a little bit, and then they'll see how the market reacts to that. What's different about raising rates now is compared to when they were raising rates before, is they were the starting point, right? The starting point now is what it is right now. Let's say 4%, even on variable, let's say it's 4%. Before it wasn't, it was like 1.5%. That's a very big difference, right? So it's unlikely that you'd see massive rate increases. But I think the only reason they would probably do it is because they just want to make sure that people aren't getting too greedy or making it too easy to get access to money. That's, I guess, the best way I could probably explain it.
Very well said. Okay, yeah, that makes a ton of sense.
Okay, cool. I'm not an expert in this. I should probably throw that disclaimer out there. That's how I understand it. Always open to feedback on better explanations on that. So let's jump into stats.
Yeah, let's do it.
Okay, so we're going to talk December 2025, and then we'll just do a quick 2025 recap. So the headline for December 2025 was 2005 Fraser Valley housing market slowest in over 2 decades, despite falling prices and decade high inventory. I mean, I don't know what else to say.
Have we talked about that?
Yeah, I feel like that's a pretty self-explanatory headline. I guess the only thing that really jumps out to me is the over 2 decades. So the housing market slowed down the most it has in 20 years.
Yeah,
so since early 2000s.
And I think what's interesting with that too is a lot of things, but in particular, when you think of the last 20 years and what they're comparing these stats to is, 2008, 2017 or 2018, it would have been with some of the foreign buyer bans. There was a lot less population and there was a lot less homes.
Yep.
So when you put that in context of it being the slowest in over 2 decades, like relatively, when you look at those numbers based off of those changes, that is massive. Like I don't think we can emphasize that enough. We'll obviously get into the nitty gritty, but I've heard some of the more. There's lots of different influences, right? Like we have a podcast, we produce content, we talk to other realtors of what they think the year is going to be like. We also consume content from other people similar to what we do to see what they're talking about, what they're saying. The more people I talk to, they are actually more optimistic about this year. Believe it or not, do I think it could still be a bit of a slower year? Yeah, for sure. But I think that relatively, like all of the things that we talk about of reasons people want to move, but also people need to move, like you can only hold out so long. I think that's part of it, not to talk about it in that way, but that's something that comes to mind. But then also too, when it's been this slow and we haven't as much data saying, hey, this is where prices are, I think you still do have in a falling market like we've seen over the last couple months since, basically April, May, some months more than others. You have enough data now, and I think people are probably more realistic to the numbers that they are going to sell at. Like I think a lot of the ballooned or heightened inventory that we're going to talk about with active listings coming up very shortly, a lot of those numbers people will need to adjust to either get to a number to sell, or they just won't sell at the numbers that they're at. So I think all of those things building up, you have all the renewals that are coming up. This will be a big year for renewals. That's Cole's forte, and he'll talk about that. But obviously, we in the Cole's notes we talked about things being more expensive, inflation, all of those things. Do I think the people that are coming up in renewal will an extra $300 or $500 a month based off of the size of their mortgage be a big difference for them? Yeah, sure, like absolutely, like that is a lot of money, like 100%. Based off of people's stress tests and what they were qualified for at that time, what they're paying, those numbers are also kind of like artificially low. And what I mean by that is, those people that were buying in 2020 or 2021, we talk about all the time about how like common or average interest rates over time is kind of in that 3.5 to 4.5 range, depending on, obviously in 2020 or 2021 we had rates that were much lower than that for a lot of reasons, and after that we saw rates that were much higher than that, but they kind of for the last quarter century been kind of hovering in that realm. Well, okay, probably not that long, but you guys understand what I'm saying. Those were artificially low. We saw some highs, and now we're kind of in the average in the middle. I think that this is just kind of, again, the adjustment of where we've been headed. Does that make sense?
I think so. Yeah, I think so. You don't have to answer this question if you don't want to. Do you think 2025 is the bottom?
Could I see prices still going down a couple percent? Yes. Like for sure. We talked about that on our predictions episode, but I also think that we're getting to a sweet spot in the sense of like, first time home buyers, if they were waiting for rates to potentially be lower or prices to come down a little bit more slightly, like we're kind of there. Even if there was another quarter point drop, again, we talk about this all the time, it's going to be roughly what, $13 for every $100,000.
Yeah, it's nothing significant.
Average mortgage size, like you've talked about, is like $400,000. So what? That's 13 times 4, $50, $55 a month. Like in my opinion, that's probably not a reason not to buy a house.
No, if that's probably not stopping you from making that decision, right? Like that $60 a month is not going to make or break you. If it is, you probably shouldn't be buying.
Yeah, 100%. If that's near the top, yeah. And we talk about as much. We've done lots of episodes on like affordability of like what you qualify for versus like what you could or should spend. And if you want to have that conversation with Cole individually, again, more than welcome to. Yeah, I could see prices going down a little bit more, but I do think that we'll start to see some more product moving, just because you're seeing more first time home buyers get off the sidelines. You're going to see a lot of those listings that were maybe overpriced before because you had the market where it was falling and people like couldn't get in front of it, couldn't catch it. But now you have months of data saying, hey, this is where you need to be in order to sell. So I think it's just going to be a little bit more, I don't know, there's just going to be more evidence when you're sitting down with sellers being like, hey, this is where this is where the data says you need to be. So I think that's part of it, for sure.
Yeah. Okay. Yeah, I'm curious to see. I think there's definitely people out there that have been waiting for quote unquote the spring market to list their place, which means they're probably listing their place now, if not soon. And I'm hoping that doesn't outweigh the demand, because that's also gonna not allow us to shift. You know what I mean? Like if there's a certain amount of people waiting to list and they're gonna push inventory back up, is that gonna hurt the market overall? It might, if we don't have enough demand, right?
Well, I think that's another great point that we'll talk about with the stats package to transition back into it. We have higher listings. We've talked about that. We've talked about that for the last 6 months, not just in this episode. Typically the spring market is the busier time of the year.
Yes.
basically from like February to April or May, you're going to see the majority of the transactions of the year, like the front 9 of the year, or from like January to July is probably like 60% of the total listings sold for the year. And then you get about 40% between August and the end of the year. So I think that increase in activity will also be averaged out by like more listings, because again, buyers will be entering the market. Sellers that also want to buy will be entering the market. So you'll see, activity increase, but those listings that were high will also be higher. So I think that will kind of like average out a little bit. Mm-hmm. So you might see relatively level, potentially HPI price of things moving from January to March, April. Okay. Again, I don't, this is all hypothetical, but I think that you will see an increase in activity because of the market, but also an increase in listings, and that might balance itself out a little bit.
Okay. Yeah, that's fair. All right, let's jump into stats for December. Before we do this, keep in mind, guys, December tends to be a slow month, which I think kind of paves the way for what I'm about to say. New listings in December, 1,350. This is down almost 40% month over month. That's a big number, but not a surprise. Austin and I, by no means, are like, oh my gosh, what's going on? It's December. Basically, the first 2 weeks of December are business weeks, and then after that, things don't tend to really happen. So this is not at all of a concern to us. Active listings were at about 7,000 in December, about 25% down month over month again. This is a funny month because it's what we expect. We expect things to be down. Now, if this was the opposite, Austin, if I told you, hey, there was 39% more new listings in December compared to November, you'd probably go, what? Why is that? Right?
No realtors took any time off of Christmas is what I'd be saying.
Like you wouldn't have expected that. So I don't know if there's anything you want to comment on there other than what we kind of just chatted about.
No, I'd say that's pretty normal. Again, those active listings I would say are a little bit higher than you normally see at this time of year. A lot of people don't have any interest in showing their place when they have family staying over from out of town or stuff like that. Like even showings were very scarce for the listings that I had that were still active over that time. A lot of people just take their listing off the market and they plan on coming back up in January, whether it's the first or second week. Totally normal. You see it a lot. I'll have a couple listings as well hitting the market over the next couple weeks. Those same conversations of like, hey, as soon as it's the new year, we're going, and just lining all of that stuff up. So kind of anecdotally, what we've talked about is currently what we're experiencing in our businesses too. Transactions, we saw 919 transactions on the MLS in December, which is a 2.5% decrease from November and about 7.5% lower than December of 2024. I would say anecdotally, it's been interesting. The last couple years, it seems like when there's been optimism about like rates dropping, that people kind of do a little bit more of their shopping. In December, like I know last year we had a couple people buy or a couple listings finally sell in December just from people getting a little bit ahead of the spring market. I'd say you saw a little bit of that, but not as much obviously this year, and I think it's all relative to sales to active listings ratios bumped up to like 13%, which is 3% higher than November. So that would call it a balanced market by the metrics that we use. Like anything 12 to 20% we consider balanced. More than that would be a seller's market. Less than that would be a buyer's market. My gut tells me that increase of sales to active listings ratio probably has a lot to do with less listings.
Yes.
So again, that's probably a little bit skewed data. Like if people didn't cancel their listings over the holidays, is that number maybe closer to 10 or 11% that we've kind of been seeing for the last little bit? Probably. But again, who's to say? Maybe us. Benchmark prices on detached properties, we were about 1%, so 1.2% down from November to December. We saw a 6.2% decrease year over year. Townhomes were actually up 0.3% month over month, but down overall year over year by 5.7%. And then condos were down about 1% month over month, bringing 5% down year over year. So overall, averaging all of that out, they were about 0.7% down month over month across all categories. Any thoughts on that, Cole, or is that just, less activity, less listings, a little bit more leverage on people buying, and that's why you see prices come down?
No surprises there. The one thing I wanted to touch on was number of transactions. I think it was higher than we expected. Like only having a 2.5% decrease is probably lower than we would have anticipated. And as Austin already mentioned, that's a big reason why we saw sales to active listings ratio be at that 13%, is because sales did better than expected and we didn't have very many active listings relative to the month before. So yeah, I'd say the only thing there that jumped out to me a little bit was we did see more transactions in December than maybe you would expect relative to the prior month. But pricing wise, no. And I think, Austin, this will segue really well into the next little bit we're going to do here. So we're just going to do a quick 2025 stats summary. So we're just going to talk about sales. We're going to talk about total new listings, and then benchmark pricing. I'm actually going to start with pricing because Austin just talked about pricing. So overall, we saw about 6% decrease across the board from 2024. So the composite benchmark price, which is, Austin can better explain this, but it's basically like average isn't the right word, but let me use
blended.
the word average. Blended price across all categories. And it came in at about 906,000. And as I mentioned, that's about 6% lower than the year previous. So prices did come down over the year. We know that. And one other interesting stat here is that's about 24% lower than the peak in March of 2022. So just under 4 years ago was the peak, and prices have adjusted by almost 25% since then. I think that's a really interesting number because when you look at what prices were then compared to now, it shines a different light in terms of people that are looking to get into the market and go, wow, the prices were there. We didn't know what was going to happen at that point. We didn't know how much they would come down. We didn't know if they would keep going up, and they have come down. So when you look at prices relative to then, it's an interesting thing to consider when you're talking about somebody trying to get into the market and maybe they're worried about pricing.
We don't have these numbers offhand, but this is just something that I'm thinking of anecdotally as we are talking about this. It'd be curious to look at prices with lower interest rates from 2022 versus prices where we are now with slightly higher interest rate, and what that would work out to monthly payment wise. We talk a lot about how the monthly payment is kind of the month that people are not that people need to crack each month.
For sure.
My gut tells me, and I think we've seen this in some cases too, I think it's more favorable to buy now in comparison with those inflated prices with lower rates. Obviously, if you're already in the market, there can be some equity challenges with that, depending on if you've bought and when and how much you'd be up or up at all that kind of stuff. So again, there's more that goes into this, and everybody's individual situation is going to be a bit different. But I think when you look at like monthly cost, I think it might be better right now than it was in 2022. And that's all speculation, so maybe we'll have to do some homework on that, but it's something to think about or kind of dive deeper into.
That's definitely something we can do a quick analysis on. Maybe we'll do a quick episode on that. What I will say... What's that?
We're just coming up with episode themes as we talk here. Don't worry about us, guys.
Exactly. What I will say about that is the price you pay for a home is the price you pay for a home. It's not going to change after you bought it. The interest rate that you're paying for that mortgage will change at some point. You're not going to be with that interest rate forever. You're going to pay down your mortgage over time. So your payments have the ability to come down later because you can always refinance your mortgage. So keep that in mind when you're if that's something that you're considering when you're making your decision. The price you pay, in my opinion, carries more weight than the monthly cost will right now. Assuming that you can manage the monthly cost, I'd much rather pay a lower price than pay a lower monthly cost at a higher price, because those people that paid that higher price in 2022 that have a mortgage, they're likely still paying for their mortgage and their cost has now gone up. So I think there's a lot to be said about that, Austin, and you make a really good point when it comes to comparing things from 2022 of March to now. There's many people that would rather be buying now than in March 2022, even though rates are higher now.
Yeah. Yeah, and obviously too, that's easier said than done. Obviously,
Of
like with
course.
more information, I know
Hindsight,
a lot.
right?
Yeah, no kidding. But the other thing I also think of too is like so many people were very thankful to like finally get in the market after losing out on 3, 4, 5, 6,
For
7
sure.
places in some scenario. Yeah, anyway, let's not rehash 2022. Let's focus on 2026.
Yeah, we'll put the crystal ball away.
Yeah, let's hop into listings listings and benchmark prices. We've already
We talked about benchmark
touched.
prices, so you can touch
Yeah.
on listings or transactions for 2025.
Yeah. Okay. So listings in new listings combined to 37,963. So almost 38,000 new listings. I would be curious how many of those would be like cancel and relists.
Me too.
Like I don't think
I
that's
was thinking the exact same thing, Austin. Sorry to interrupt you here, but I'm wondering how accurate that stat is. Like, is that every time you relist, it counts as a new listing, or is it just specific individual addresses, assuming a sale hasn't happened? That's what I'm
yeah.
curious about.
So for those of you that are sitting here listening, being like, what
is
are
he
they
talking
talking about? So sometimes what people will do if they are adjusting a price on a property is instead of just basically changing the price from like X to Y, they'll cancel the listing and then relist at a new price. That technically counts as a new listing. And for us stats nerds like Cole and I, that can throw a wrench into some of the stats. So I guess what Cole is kind of saying is, just under 38,000, so 37,963. Is that unique homes listed or total amount of listings, which might mean that the homes that have been listed 2, 3, 4, 5, 6 times, and yes, sometimes it takes that, or people will do it that many times. Does that contribute to that? Like in some cases, you definitely list at a price and it sells within a couple weeks. From my experience, doesn't happen very frequently for a multitude of reasons, and I'm not saying that for just my listings. I'm saying that just across the board. Yeah, it takes me 3 or 4 times to no, that's not it. But it's very frequently you'll be looking at a property that hits the market and it's been on 2, 3, 4 times when I'm working with buyers. Anyway, that's listings. Then transactions total was 12,225 sales in 2025, which is a 16% decrease from 2024 and 33% decreased across the 10-year average. One fun stat that we noticed was that Surrey accounted for about half of all sales, which was interesting. Obviously, Surrey is a very big city and a very big catchment and lots of inventory. When we look at the Fraser Valley board, which consists of Surrey, Langley, White Rock, Abbotsford, that's basically it. Yeah, Surrey, Langley.
Does it include Maple Ridge, Mission,
No,
any of those?
Maple Ridge is and Mission or Greater Vancouver Real Estate
Vancouver,
Board.
yeah, okay.
So yeah, obviously Surrey is the like a large city, and it spans like quite a bit, and again, lots of density, lots of listings. But that we thought was kind of an interesting stat to throw in there, and of course, like Cloverdale is obviously also considered Surrey, as much as we call it Cloverdale. That's definitely City of Surrey. Yeah, so that's what we have. Cole, do you have anything else to add on this episode as we wrap up here?
No, that's it, guys. We just want to give you guys a quick recap of 2025 as well as look at December stats. I'm going to make a really bold prediction here, Austin. I expect January to see an increase in some of these categories compared to December, especially when it comes to active listings. Sales, that'll be an interesting one because sales did better than expected in December at 919. So I'll be curious to see if we have more than that in January or not. Yeah, I'm. That's kind of the one thing I'm interested in is let's see if we see more sales or not.
Very well said. One thing I'm going to touch on that I've seen lots of other people posting about, so it's my turn to do a reel on it. BC assessments just came out. So this was a crave like last week on social. I've seen lots of people post about BC assessments. If you plan on using that for your market value, do me a favor, look at your BC assessment paper, crumple it up, try and shoot it into the garbage. BC assessment value does not determine market value. If it was as easy as like, hey, we're going to list at my BC assessment number, you wouldn't need people like us. And I know you guys can sense a ton of sarcasm here, but I'm going to break down why that is, okay? One, that number is taken from July of last year. We, for the last 34 minutes on our podcast, have talked about how the market has changed since July and this whole year. So take that as one factor. Two, BC Assessments, the way that they do it, they're not coming into your home to look at your renovation that you've done or the suite that you've put in if they don't know about it. Anyway, not going to go into detail on that. Or maybe your house is in not great condition and they don't know that. So again, there's so many different factors that go into BC Assessment. If you want the market value of your home, please call me and we can talk about it. BC Assessment, they're an interesting tool. They're fun kind of things to talk about, but it's not market value. So unfortunately,
you know what BC Assessment's good for, Austin?
What?
Property taxes. That's really what it's for.
Yeah.
Right? That's the only thing I think it's really valuable for, is it determines how much property tax you pay. And little sidebar, if you don't agree with that assessment, you can dispute it if you think you're paying too much property tax. But that's on you guys. That's not our area of expertise, but just note that you don't have to necessarily agree with what the assessment is. Now, if you think it's higher, then keep in mind you're going to pay more property tax if you request for a higher assessment. And I think this actually really goes into what Austin just said.
Yeah.
Don't request a higher assessment. It's not going to change the market value of your home. It's not going to help you sell your home for more. It's just going to make you pay more property tax. So only do what I'm saying if you think it's worth less in terms of the assessment, because maybe you'll pay less property tax. But anyways, all this to say that that's really what it's for. And Austin's absolutely right. Do not base your market value on that.
Say that again for me, Cole. No, I'm kidding. I won't make you do that. Thank you guys for joining us for another episode. We do appreciate it. If you found this episode helpful, please share it with your closest friend or family member. Obviously helps Cole and I, and we hope that you guys get a lot from the episodes that we put out. So signing off, I'm Austin.
And I'm Cole.
And you've been listening to the Full Subjects podcast.
We practiced that.